Toronto's rental market has lost its sense of urgency. So we're no longer seeing people scramble to secure a unit within hours of a listing going up.
Breaking news. America's rental market is imploding. Vacancies just hit their highest level since 2012, and in some cities, rents are collapsing by more than 20% in a single year. Landlords who once named their price are now slashing hundreds of dollars a month just to keep the lights on. From overbuilt towers to Airbnb meltdowns, what's coming next could shatter the U.S. housing market for a decade. Across the U.S., rents are falling at a pace not seen since the 2008 housing crash. On April 2025, U.S. median rent posted its 21st consecutive year-over-year decline. The national median rent has now dropped for 10 months in a row, a streak that's breaking records. Vacancy rates have jumped from 5.6% in early 2023 to 7.4% by mid-2025, the highest level in 13 years. Cities once seen as unstoppable rental markets are now bleeding value. Austin has seen rents drop by 21% from their peak, while San Francisco is down 24.3% year over year. Tampa and Nashville are both seeing double-digit declines. Housing analysts are calling this the biggest power shift from landlords to tenants in a generation. In simple terms, properties that once rented in hours are now sitting empty for months. The numbers aren't just bad, they're historic, and they point to a rental market that is not slowing down its fall anytime soon. In many U.S. cities, landlords are facing a rental market they no longer control. Homes and apartments that used to be rented within a day are now sitting empty for weeks or even months. Many owners are cutting rents by $100 to $150 every single week just to get someone interested. Property managers say tenant applications have fallen to their lowest level in 15 years, leaving more units without renters. Some landlords are now allowing pets, lowering credit score requirements, and even offering free months of rent to fill empty spaces. These changes were unthinkable just 2 years ago when demand was sky high. The power has clearly shifted. Renters now have more options, more leverage, and more room to negotiate. For landlords, every empty month means bigger losses, and for tenants, it's the best time in years to push for lower prices and better deals. During the pandemic, millions of Americans bought homes in new cities, thinking remote work would last forever. But now, many companies are forcing employees back to offices, leaving these owners stuck with properties they can't sell without losing money. Instead of paying thousands each month for an empty home, they are choosing to rent them out, often at a loss. This has created a wave of accidental landlords, people who never planned to be in the rental business. Experts estimate that there are now over 500,000 of them across the U.S. These landlords are competing with experienced investors and big rental companies, driving rents down in entire neighborhoods. Many are also offering big deals or incentives just to get tenants in the door. The result is a rental market flooded with extra supply, putting even more pressure on prices to fall. During the pandemic boom, U.S. developers rushed to build record numbers of apartments, believing demand would never slow down. Cities like Dallas, Austin, and Jacksonville have seen the largest waves of new construction in their history, with thousands of units hitting the market in just the last year. The problem is demand has already collapsed, leaving many of these buildings half empty. Developers can't stop construction once it starts because financing contracts force them to finish. As a result, brand new luxury towers are offering 3 to 4 months of free rent, no deposits, and free amenities just to attract tenants. Yet, even with these deals, base rents are still far higher than most Americans can afford. Many complexes now face rising maintenance costs and shrinking returns. For renters, it's a rare opportunity to get high-end living for less. But for developers, it's a painful reminder that overbuilding can turn profits into losses overnight. The short-term rental market is taking heavy losses across the U.S., with occupancy rates for Airbnb falling from about 57% to close to 50% by mid-2025. Cities like Phoenix, Orlando, and Miami are drowning in oversupply as thousands of new listings push nightly rates down to their lowest levels in years. Many hosts are struggling to cover rising costs, including insurance premiums that have doubled or tripled in some areas. On top of that, local governments are cracking down with stricter licensing rules, new taxes, and fines that can reach tens of thousands of dollars. Faced with falling profits and mounting expenses, many owners are abandoning short-term stays and switching to long-term rentals. This sudden shift is adding even more properties to a rental market already flooded with supply. For travelers, it means cheaper stays, but for hosts, it's a financial nightmare that's forcing many out of the business entirely. Landlords across the U.S. are being hit with rising costs that eat away what little profit they have left. Property taxes in many states have jumped by double digits in just the past year, especially in high-demand areas. At the same time, insurance premiums are soaring. Some owners face increases over 20%, with average premiums rising 21% in 2023 and projected to climb further. These increases come on top of higher maintenance costs, as labor shortages and inflation make repairs more expensive. Replacing appliances, fixing roofs, or even doing some basic upgrades now costs thousands more than before. For owners who bought during the pandemic boom at peak prices, the math no longer works. Many are already losing $800 to $1,200 every month just to keep their rentals afloat. These losses can quickly add up to tens of thousands a year. Some landlords are being forced to sell, while others dip into savings to cover shortfalls. Even large corporate owners are feeling the pressure, cutting back on purchases and delaying renovations. The rental market slowdown means they can't simply raise rents to cover these costs. For many, the passive income dream of real estate investing has turned into a financial drain that's getting worse each month. The rental market crisis in the U.S. is hitting harder than in many other countries because of how the system is built. For decades, wages in America have grown much slower than housing costs, making rent unaffordable for millions even before this collapse began. U.S. housing policies often favor big investors and developers over protecting tenants, allowing rents to climb far faster than incomes. Unlike many countries in Europe or Asia, America has weak national tenant protections, leaving renters with little security when markets shift. This means that when prices drop, landlords and investors feel the pain first, but renters still face instability. The overbuilding boom, combined with high interest rates and corporate ownership of huge rental portfolios, has made the crash deeper and more damaging. In the U.S., housing is treated more as a business than a basic need, and that makes the fallout far worse when the market turns. Experts warn that the U.S. rental market could face years of pain before it recovers. In some cities, rents may not return to previous highs until 2030 or later. If interest rates stay elevated, thousands of landlords could face bankruptcy as vacancies rise and profits vanish. Analysts also predict the national vacancy rate could hit its highest level in history by early 2026. Overbuilt markets in the Sun Belt and oversaturated tourist areas will be hit the hardest. For renters, this means more negotiating power, but for property owners, the storm is just beginning. The collapse we're seeing now may be only the first chapter of a much larger housing crisis. The U.S. rental crash isn't a blip. It's the opening act of a housing crisis that could last for years. Subscribe now to stay ahead, track every market shift, and see the truth America's landlords hope you never hear.